Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I will be your host for the next 25 minutes here on Options Guide TV. So Chicken Little was screaming all day Friday afternoon that the sky was falling, and we wake up this morning and not only is it not falling, it is bouncing hard off the ground, I guess. Dead cat bounce. I mean, how many different analogies can I do here? I find it very interesting. We still see a little bit of weakness, like we have Google down a little bit today. Apple, Tim Cook is retiring. That's been a stock that's been in the news a lot recently. Have Nvidia up 1.5%, Oracle's up just a smidge, and that's the stock we're going to look at today. So S&P 500 index is up 1%, which is solid considering how everybody was so concerned about everything on Friday. Still a lot of things to be concerned about. CapEx spends. It seems like we might have to print money just to be able to make up for all the CapEx spending that is going on in AI and in the space. And there used to be that when you overspent, you got beat up for it. Now we're back to the scenario that there's a limited amount of money out there. SpaceX is coming public, and so we got to grab as much money as we possibly can. So it's a cash hoard event, and we saw Meta get beat up for it. As a matter of fact, I'm kind of curious. I don't see where Meta's at today. Yeah, Meta's still down today. So Meta is probably the company that's getting beaten up the most over their AI spend and what they're looking to do. Nvidia just trudges along. It's trading right at 208. It's up 1.72% today. But it's not, the volatility has kind of waned a little bit on it. And we have Netflix just kind of hanging around in the background. That's at 82.67. I still like Netflix because it's out of that mess. To me, Netflix is interesting in that it's in the Meg 7. And it's kind of a hedge against the AI spend. Also, Apple falls into that place too. So does Apple get burned by this? Are they leaning too heavy on Google? Does that give too, it's all about the hardware. It's all about the iPhone at this stage is half of the company's revenue. And they still maintain that hold on the operating system. And if you want to use the Apple Store, you're going to pay a fee to Apple, and they push back more and more so. But I personally love the fact that Apple charges that fee personally as an iPhone user, mainly because I know that if I click on an app, I'm not going to have a bug that's going to ruin my phone. And a lot of people just take that for granted, that when you use Apple and you use their operating system, one of the biggest things, and I don't know if Apple just doesn't mention this because they don't want to jinx it, but if you're using the operating system and you're using the iPhone app, it's very hard for the bad guys to break through, even though they pay up for it. So little known secret, if you want to sign up for something that has an app, you'd better go online. If you go online, you can get it cheaper, because if you don't buy it through the App Store or sign up through the App Store, you actually get a discount on it. So these are all little just fun things. Oracle. I liked our trade. We did a trade. Stock went down. Stock bounced back. Stock is back again. Stock is up today. Oh, no, it's flat. I'm sorry. It's down 50 cents on the day. Announcing earnings after the close on Wednesday. I like Oracle. I like that the data centers are being built. I don't like the leverage, but they were the first ones to say we'll spend anything to participate in this. And because of that, the fact that the data centers are getting built, I don't know how else to say it. This is the main reason why I want to get long Oracle going into earnings. Now, we looked at a speculative trade, and we'll start there. Let's go to the paper trading portfolio here and the Trader Pro software, and let's look at that Oracle position. So in Oracle, on Fundamental Fridays, we sold a put, and we talked a little bit about selling that put to cash secured to buy the stock. But the trade that we highlighted on Options Guide TV is we did a diagonal trade. There was a lot of volatility, and I'm going to jump back to the options grid just real quick but the IV has gone up on the longer term option. This was right about 130, and it's now 150. And the near term option, the option that expired, that we actually captured the capital on, that was trading at about an 88% implied volatility. So even though it was a week out, and I think I mentioned on the show that I would have liked to have done this like with 2 weeks out, that option contract actually expired worthless. And that gave us an extra $3 to help offset a lot of the implied volatility spend on the longer term option. Now, if we look at the chart, we didn't want the underlying to blow through our short strike, which I think was at the 260 level, but we didn't want it to go down either. So we're hanging out in this range. Ideally, you would have liked it to just stay where it was at and rode it into earnings. I'm going to go up 1,500 days just to get the 200-day moving average. But I do think that the 200-day moving average, this is one of the only companies that's not way overextended relative to the 200-day moving average. And we have this little gap opening. We got the 200-day, we got the 20-day conversion, we got the 50-day moving up. These are signs of a healthy stock that hasn't been healthy for quite some time. We had the consolidation period down here coming on into earnings. As a matter of fact, you could even make an argument, and I just kind of seeing this right now. Let's just grab this part right here. You could make an argument that this is forming a very wavy cup and handle. All the way down. I always like the cup and handle. Like, we just need to get that last finger on up so that you stick your pinky out on your teacup. But with that said, if this could be the catalyst, this could be the catalyst. You got the 200-day here. You got a lot of things that are looking good. Now, we're still the PE ratio is high on the trailing 12 months. The forward PE, who really knows? It's all about the spend and when are they going to start to get rewarded. They're 100%. There's a PR campaign out now to try to get communities to buy in. These are all the good things that are going to happen because you do this. We're going to actually lower your energy bill. We're going to recycle water. We're doing all this stuff. We're so great. You guys should love having data centers in your backyard. That is the message that's going on. And I think it's good that they're doing it, and they're going to continue to do it. I'm saying it's good for the company. I don't have an opinion on data centers, at least not on this show. I don't. But there is a rush that's the new gold rush, right? Data centers. That instead of panning for gold, you're building data centers, and Oracle is right in the middle of that. So here we go. Let's get long it. I'm going to go out. We have the earnings inside the portfolio. Our expiration date is 6/12. So in here, I'm going to go out to the 18th. I'm going to go 10 more days, and I'm going to do the open wing butterfly, but I'm going to do it wide. As a matter of fact, I might actually look at going wider than this, but let me throw this into the profit and loss calculator, because $300, I don't know if I were to try to test the waters on a trade and I was first doing a trade for my first time. $300 is a decent amount of spend. If you just do one butterfly, 1x2x1 open wing butterfly, and I always have to throw in that this is not meant to be a recommendation, just to keep everybody happy. But 285 right now, and we're 20 points wide. And one of the things I like about going a little bit wider is the difference from here to here means a lot as far as time decay is concerned. This would be, let's say the stock went to 230. This is an at the money. We're still 20 points out of the money on the 250 strike, and you'll see time wither away. So the fact that I'm going longer, I like to go wider on the butterfly. If that makes sense. And vol is way up on the June 18th also. Obviously, if you're chasing vol, this is the expiration that you want to look at. And maybe on Wednesday we'll consider I don't know, we'll maybe look at a different trade on Wednesday, because they're announcing after the close on Wednesday. And I always want to double check myself. Yeah, that is on Wednesday, and I'm pretty sure it's after the close. That's the earnings date right here. All right, and let's set this up. Okay, so we got the stocks at 215. What do you guys think? Oh, hey, Kurt, good morning. You want to go wider? I'm kind of curious. I'm kind of going there. Might go a little bit. I've never really done one more than 25 points out, and obviously the size of the stock matters. But I love that this is still at 107 vol on the at the money here. That see this vol on the put side is 120. What's the vol over here? 114. Expected move, if we look at this expiration and we look at the most at the money options, 15, so we're talking $32 to, we'll call 30, so that's 145. That should be a 27 delta. All right, 30. Yeah, I don't mind. Let's go a little bit wider. I don't want to make this the official one. Let's do something different. Let's try going 30 points. $3. 30 points is probably going to add another $2 onto the trade, which is a little bit expensive for the trades I usually pick out for Options Guy TV. So that's a 20 delta right here. Stock's at 215. It's up 57 cents on the day. They're hanging around waiting for earnings. I mean, that's my opinion on it. 230. So then we go 15. 275. Now this would be if you're going just half, right? So you're 30 points and then half of that is 15. Yeah, 436. I like that. So pay $1.36 more to get an extra potential of 10 points. And let's send this. This is going to be the official paper trade. And let's talk about it. All right. So we have that there. And I'll give you the read back. Changed my mind. I'm not going to go 20 points wide. I'm going to go 30 points wide. Oracle's announcing Wednesday after the close. Okay, let me get this all set up here. Here is our read back. 1 second here. Come on, thing. Don't tell me I just froze. Aha. Markets are moving. All right. So Oracle is announcing earnings after the close on Wednesday. The stock right now is at $214.19. We're going to go on the call side of things and be bullish heading into earnings. We're going to take advantage of this high implied volatility, and we're going to go out to the June 18th expiration, one expiration away from this Friday after that earnings report. We're looking at 10 days out. We're going to be buying the 230 strike call. Going to go all the way up to the 260 strike call, and we're going to sell 2 of those, and then we're going to go up 15 points to the 275 strike call, and we're going to buy 1. The width between the long spread of our butterfly from 230 to 260 is 30 points, and in our short spread that we're using to pay for the butterfly, we're going from 260 to 275. That's 15 points. That means that if the underlying stock blows through all of our strikes up above the 275 level, this butterfly should still trade for $15. And that would mean $1,500 per 1x2x1 butterfly if we blew through all the strikes. And let's show that in the what if calculator here. If we look at, here's where the current stock is at, 213.78. We're going from 230 to 260. That would be the maximum on our trade. And then from 275 on up, this is the most that we can make above and beyond. And it's saying right now it's $1,067. I'm going to highlight it right there. And that's based off of the price that it grabbed when we came into the what if calculator. We're putting it at $425. We're going to call that $425. And we're going to send this down to the trading floor. So I'll send it at $425. I'll make sure it fills. But if we send it now, boom goes the dynamite. Order has been sent. All right, so $425 will be our risk on this open wing butterfly, 1x2x1. So anywhere below 230, we're out of luck. We got a little bit of time though. Then, by going a little bit further out, does give us the option for the underlying to come back. But this is definitely a bullish trade. It's an alternative in my mind to a long call spread. in that if I just did the long call spread, I'd buy the 230 and I'd sell one of the 260s. But the reason why I like open wing butterflies better around earnings is that you get to sell two of the 260s, two of those pumped up way out of the money implied volatility options. And if we don't quite get there, that's going to collapse real quick. Like now, by going wider on our butterfly, by wider I mean going from 230 to 260 instead of 20 points. You see the profit and loss graph as of right now, give yourself a little bit more upside. And that's because you are wide enough that you can get enough time decay on the 260 strike if we land anywhere between 230 and 260, anywhere within that range. That would be ideal. Now, if the market continues on up, that's fine. And we got an extra 10 days for it to come back. So if it's hanging all the way up here and it starts drifting back down after the earnings, I mean, you'd be blowing away the numbers right here if it happened. Well, we got to hedge. And if it comes back here, it's actually better for us. So the difference with that versus a long call spread or a bull call spread is that you're worried if it comes back to your strike on the bull call spread because you just don't want it. You don't want it to start working against you quicker. It's not quite the case with the open wing butterfly. Now, what's the downside then, Brian? Everything you're saying is a positive. What's the downside? Well, the downside is that you can't make as much if it blows it away. You've spent some money here. That's money is going to be detracted from your overall gain. So like if the stock ended up at 300 after earnings and you had a huge gap opening, not saying that's going to happen, but if that did, you would have been better off just doing the long call spread as opposed to the open wing butterfly. But you would have had more money up front that you would have had to spend on that trade. So around earnings, open wing butterflies make a lot more sense to me if you want to get directional than buying a long call spread or a long put spread if you want to get bearish and buying that outright and paying all that capital up front. So this is the official paper trade. So let's go back and look in the orders. So we have our trade in 425. This is where I would be working it. And you got a day to do this, right? They're not announcing on Wednesdays. I'm going to be finicky about getting the midpoint. I want to trade somewhere near the midpoint, and I can watch it. But we're doing the show, at 11 o'clock every Monday, Wednesday, and Friday. Friday's Fundamental Friday, but we do it every Monday, Wednesday, and Friday. I'm sure you all have your alarms set to make sure that you log in to watch the show live. But with that said, this is the price I would work it at. Now, we're on the show, and I want to get it filled, and the market's already moving. Let's put it down to, let's go 390 in the paper trading app and see if we can fill it before the end of the show. So here's the trade. It's down here. I'm going to go right between the bid and the mid. But once again, it's a paper trading app, so you got to work it a little bit more. If you're trading around earnings and you got high volume, high volatility, high open interest, I'm going to work the order and try to get somewhere close to a midpoint. I would watch it. I wouldn't just send it to the floor and just let it sit. I would work it. And that's the way that I would always trade if I'm going to do a highly speculative short-term trade like this in Oracle. And also to go along with it, go back to our portfolio. Don't forget, we are long the 255 call. The right now it's trading for $3.45. We put it on. The total cost I think was $9 when we put the trade on. So we have this for $3.45. We can sell a call against it if you would like. We've already made $3. It was, I think, a net of $9 on our calendar spread. So now that the stock has actually gone down, it's hurt us more than it's helped us, right? So let's go out and take this position on a shorter term basis and say, I don't want the cheese anymore. Just let me out of the trap. So here's how I want to adjust that Oracle trade. We might have done this on Friday when we knew that the shorter term option contract was going to expire, but we did Fundamental Fridays. So with that said, here is the way I would approach this. You want to stay in the same expiration, which is the June 12th expiration. We are up at the 255 strike, which is about one standard deviation out of the move. It is trading for 330. So we could go 10 points here and get 265 and bring in the 241. All right, so let's do this. Let's go 10 points wide. And I'm always cognizant of where my cost basis is at. All right, we put the trade on for $9. The stock has gone down, but we captured $3. So we've already made $3. That's in the bank. That's already done from our short-term option on our diagonal spread. So we still have $9 at risk here. We want to make sure that we can be profitable on this trade if we're correct on our forecast. So we want to go wide enough to cover that and at least make us profit. I don't want to go only 5 points wide because then the maximum you can make is 5 points. So we're going to try to make at least 10. We're going to sell the 265 and we hit that. And that's trading for $2.49. So that's going to bring our cost basis down from $9 to $6.50 on the trade. So now we have $6.50 at risk. The option contract, if we go all the way back to the very beginning when we were looking at this trade, and realize we also filled this in the paper trading app. So I don't know exactly how much I adjusted it relative to the show, but let's look at it. And it was trading right around $16 at the time. And we must have got a lot more for the short-term one. But with that said, so that was $16. It's $3.45. Gosh, if we would have bought that outright, how upset would we have been, right? We'd been better off if we just didn't buy the trade, and we could buy it right now for $3.45. But that allowed us to ride it. We had good momentum to the upside. And now we've withered away our cost to bring it all the way down to $6.50. And now that's what we have at risk, $6.50 total. Still have our position on, looking for a strong move to the upside, heading on into that earnings. And I still would ride it into the earnings, especially with the Wednesday scenario. But I do want to put this on, and I would sell this. It's 100% the way I would manage this position if I had this portfolio on. So 250, I think, is very feasible. Market's not that bad, 243 by 258. And we're going to roll into a long call spread. And you could roll into a skip strike butterfly if you wanted to. If you want to bring in a little bit more premium, you could do that. But I'm just gonna. I don't want to get too fancy here. This is a very solid trade. Still getting a lot of premium. You're still cutting your cost basis in half. You're still giving yourself some upside. Let me send this to the trading floor. So let's just do this. We're gonna sell one June 12th, this Friday expiration. 265 call, and this is going to create a long call spread in our portfolio. We'll be long the 255 strike call and short the 265 strike call, making the maximum the width between the spreads, which is $10. We're going to bring in $2.45 by doing this. We'll call it 250. Let's go 250. Market just moved a little bit, and that's a nice round number. So we'll go $2.50, and boom goes the dynamite. Order has been sent. All right, so options grid. We want to look at orders. Here is our short, and we're working this one to try to get it done. Now, don't move this. Just because I did it on the show, don't try to or go up. Well, we got to pay more. I went the wrong damn way, didn't I? All right, let's remove this. This would be 450. I went the wrong way. But 425, I think, is a very fair price. Keep it right at about 425, and boom, send that to the trading floor. I do think you can get filled at that price. Okay, Kurt likes, and go ahead and put that comment up. Yeah, 298, and I don't mind that. Paying a little bit more. Now here's the difference. Kurt says that he likes the 230, 250, 260 better, the 20-point wide one. Let's look at the options grid. Okay, so here's the difference, and the difference is this line. This really starts morphing towards the middle when you get a lot wider. So that it behooves you to be wider. If you just think about time decay, the time decay of an option contract that's 30 points out as opposed to one that's 20 points out. And that's not, I'm not saying that's better because you're obviously paying more. And if you're wrong, you'd rather do the $3 one than the $4 and what is it, 25-cent one. But with that said, see how less, how much more of a flat line you have. That's the best way to say it. On the profit and loss graph as of right now, as opposed to this, where we get a little bit more curvature and we move up quite a bit too. So let's look right here at the 238. This is a good judge. So that's $400. We'll go maybe 240. We'll look at 240. 240, you're up $500. 240, you're up. Oh, wow, we're actually up more. Right there. Oh, because we're paid less. Yeah. All right. I guess you can look at it that way. Well, I don't mind it. I don't mind it, Kurt. I like it. Stock price recently hit 250, so thinking it can get back there easier. And let's go. I heard. I'll go ahead and put that in. Put up the next comment. That's fair. Logical. So you're basing it more on the chart than on the price and potential movement. So let's go look at 250. Yeah, here's the 250 level right there. That's where we hit, and there might be a little bit of resistance in that level. And over here was the recent high. That was 258 at 260. But here's the big gap, right? This is what you'd really like to see filled if you're an owner of the stock. Is from 240 and a half all the way up. That gap goes all the way up to 312. Wow. All right. Bottom line is we're going to get long Oracle. It's the one stock, you look at all these other stocks that's in this space. Micron is up again. I was kind of hoping it would come back down a little bit more, but it's bounced back up 10%. I got to admit, I'm a little bit annoyed on that. I was hoping that it would be down a little bit more this week because I wanted to buy a little more of it. And now it's already bounced back. It's up $94. I only got 100 shares of it. I'd like to have a little bit more. And now we go in and look at what else? Dell. Dell has been one of the stocks. Look at that chart. What else can we toss in here? That's just crazy when you just look at the charts. Let's bring this down. Let's go about 300 days. Let's go 1 year out. And so a lot of these stocks have just been crazy. And then you go in and you look at Oracle, and rightfully so. They've done more. I don't leverage themselves more than a lot of these other companies. Micron, you could still even say, is trading at a decent valuation, or the reason why the stock is where it is. Meta is down, and Meta is getting beat up for their spend, and they're down again today. And Amazon's been all right. I think that Amazon is another one of the companies that I wouldn't mind. I think that their strategy is good. Everybody's all of a sudden making a mad dash for cash, trying to get to spend out before the space. I think SpaceX has really affected it. A lot of people are making the argument that the IPO with SpaceX is what drove the market down on Friday. But if that was the case, then why didn't it continue? Why didn't we see more of that right now? I guess the dash for cash is okay. All of a sudden, the marketplace is all right with it. IBM is an interesting one too in the hardware space. Look at that run all the way up. Wow, it didn't even pause once it broke through this recent high. There's the top of that candle is 341, but I'd say right through there, 1, 2, 3 touches, you would think you'd get some support on that. But man, that is a very crazy chart in IBM. finally getting finding a little bottom here right at 285, and it's 285.49. It's down 35 cents on the day. All right. Any other questions, comments? Wednesday, we'll come back. I'm going to keep playing with Oracle. I'm going to play with Oracle a lot this week. If there's any other underlyings that are announcing earnings that you want me to look at, AMD is another one of them. That's also an interesting chart. There's a parabolic move to the upside. Finally getting a little bit of a sell-off. Energy stocks are back in the favor too. Seeing Exxon up 1.89%. Where's our next power? NXT. I stopped trading that because I couldn't get fills in it. But Kurt said that he got a fill inside the chat box. I got a fill on the one trade around earnings on the skip strike butterfly. But that's still hanging out. It's kind of weird, but in Next Power, the one thing that I like is that there's not weekly expirations. But I wasn't able to get the fills that I was able to get around the earnings report. 135, 140, 280 by 210 on the calls. That's a little wide there. 140 by 85. We're getting wide on the out of the money ones. We got a little bit open interest there. Yeah, it's still. I think it would be tough to get filled. I think it would be tough. All right. Still in NXT. All right. Well, you're looking good, right, Kurt? Go ahead and toss that out. Waiting for the options to expire worthless. All right. And that's what the plan was. We looked at the skip strike butterfly as an alternative to a short call spread. And I think if you make that approach and you think of it that way, then you know going into it that my goal is to try to make that net credit. And then you can decide, I'm not trying to pinpoint where the stock's going to stop. I'm just doing it as an alternative so that I have a hedge already baked into the trade. And sometimes I've done trades where you get kind of the move to the upside and then you put the butterfly on later, but you just don't get the benefit of that pumped up implied volatility like you do around earnings. But think about a hedge where you have a short call spread and you put a butterfly on it and you turn it into a skip strike. It's not a bad hedge, but you have to spend money afterwards. And a lot of people just don't like to do that. If I do it, I don't want to spend more than the net credit that I received. So then I just make it a zero-sum trade. And if the stock does move up towards the strike, maybe I make some money above and beyond. But that is definitely, I don't want the cheese anymore. Just let me out of the trade. All right. Yeah, that makes sense, Kurt. And not very liquid options, right? Especially now that we're out of the earnings season on it. I see, to me, here's the two things that I like, and I'm not really saying it, I'm thinking it, but I haven't really said it, and I just put it down here, is NXT is $130 stock trading at an 88 vol. And that makes it interesting, but I want a little bit more liquid markets. Now, the fact that there's not weeklies out there helps with liquidity because there's just not as many options out there to trade, but we're still seeing kind of weak markets. But I love that you have $133 stock trading at an 88 volatility. I like the combination of the two. You're getting some premium because it's a fairly expensive stock, but you're getting a lot of premium because of where vol is at. And if you're looking at the shorter term, all that vol's got to come off, right? By the June 18th, in 10 days, it's got to go away. But it's still trading at a 135 strike. The most at the money strike is still trading at we'll call it 720 at the midpoint. So yeah, interesting how that is. All right, I'm getting a little long. Thanks for stopping in. Wednesday is the big day. Come on by. We'll look at another trade and let's make sure we get filled on okay, we're filled there. Good. We needed to get filled on our hedge. This is our hedge on our long call option. This is our long butterfly. I went the wrong way with it. But now we're at 450. Even in the paper trading app, we should get filled at 450. All right. Thanks for stopping in, everybody. See you Wednesday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.